Welcome to class 11 of Business Environment. So in this class we are going to study about balance of payment. So balance of payment is popularly called as BOP. Suppose they ask you in the examination expand BOP, you may write balance of payment. So here, what is this balance of payment? To check its profitability, so the company to check its profitability or a health of the company, so it have an instrument called as balance sheet, right? So balance sheet will have your assets, liabilities, etc. So here country will or if the country wants to check its economic health, so it has balance of payment. So balance of payment is nothing but a sum of all transactions of the country. We call it as balance of payment. So it is a summary of foreign economic transaction of nation, so that we call it as balance of payment. And this balance of payment may be favorable or unfavorable. So when we call it as favorable, so balance of payment is favorable when it shows surplus on account. So surplus on account means here BOP and the nation's receivables are more over its payable, so then we have surplus. If the nation's receivables are more over its payable, so then we have surplus, which means it is favorable. So if the company shows the deficit, or sorry, if the economy or the country's BOP shows deficit, so we can say it is unfavorable, which means the payables are more over the receivables, so that is unfavorable. So here BOP is nothing but it is a summary of foreign transactions of a nation are called BOP. So it is a record of receivables and payables with the foreign countries. So it gives the list of receivable from the foreign countries and gives the record of payables to the foreign countries. So this we call it as BOP. The next is BOP classification. BOP is classified into two: current account and capital account. So what is this current account? So this current record transaction, or this account records the transactions that are current. Current means present, right? So receipts and payment item that pertain to the period of 12 months. So we say current, right? Pertaining to 12 months. So that we call it as the current account. So the balance in this account, that is deficit or surplus, so is transferred to capital account. So in short we can say current account is equal to balance of trade. So balance of trade is nothing but the transactions recorded in the current account are import, export. So this we call it as balance of trade, and this current account is equal to balance of trade. So which will be pertaining to only 12 months. So here current account is further classified into visibles and invisibles. So what is this visibles? So visibles account refer to mainly goods account. So goods account means we are going to import, we are going to export. So that we are going to call it as visible account or visibles. This accounts on import and export of goods is recorded. So in this account we are going to record the imports and exports of goods, and difference on these accounts favorable when the exports are more compared to imports. So visibles are favorable when the exports are more compared to your imports. Unfavorable when the imports are more compared to the exports. So the balance in this account is transferred to the current accounts. So I repeat, BOP is classified into two: current account and capital account. In current account, what happens? You are going to record the transactions that are current, which means the balance of trade. So the transaction relating to your import and export, you are going to record it in the current account. So the balance in this account may be deficit or surplus, so that will be transferred to the capital account. So the deficit or surplus what is there, so that will be transferred to the capital account. And this current account is of two types, so which is visible and invisible. Visible means it is referred mainly to the goods account, so what we are going to import and what we are going to export, and this is the record. So import and export of goods is recorded in the visible account, and this account may be favorable and unfavorable. When it is favorable, when you are going to export more compared to the import, it will be favorable. When you are going to import more compared to export, so then it is unfavorable. So the next is invisibles. So what is this invisibles? Invisible is nothing but, so they refer to the foreign receipt and payment that are not visible. Okay, so they mainly include transactions on services like your finance, tourism, insurance, dividend, interest rates, etc. So all these things are invisible. Okay, along with the unilateral transfer. What is this unilateral transfer? Unilateral transfer means gifts, donations, etc. Okay, so balance in invisible account after 12 months, it is transferred to the current account. So current account records the transaction of receipt and payment of accounts of visible as well as invisible items. So and the balance in this account is transferred to the capital after 12 months. So the duration of this current account is 12 months. So whatever takes place, receipts and exports, so it may be the service or it may be the goods. So whatever takes place or whatever transaction takes place, so that will be recorded in the current account first, and after 12 months it will be transferred to the capital account. So the next is your capital account. So what is this capital account? So capital account is nothing but it may be the foreign transaction, that is receipt and payments that are for a period more than 12 months, right? So more than 12 months and recorded in this account. So in capital account we are going to record those transactions which are prior or more than 12 months. So after 12 months what happens? We are going to record this transaction in the capital account. So this mainly consists of your loans, FDI, deposits, so profit, interest, etc. So balance of current and capital account together will be termed as BOP. So which may be favorable or which may be unfavorable, right? So what happens here now? Current account and capital account. In current account what we do, whatever we are going to record in these 12 months, after 12 months we are going to transfer it to the capital account. And in capital account whatever we are going to transfer, the combination or we can say these two together, current and capital account, will take a term called as balance of payment. Then the next is economic reforms. So what is this economic reforms? So there are the policies. New economic policy 1985. So it is the first phase of new economic policy. So this policy was initiated in the year called as 1985. So by the young and dynamic Shri Rajiv Gandhi became a Prime Minister of India. So what happened? Under the Congress leadership, so Congress government leadership, they tried to give a new direction to the Indian economy. So there are some objectives. So the objective may be to make Indian economy most competitive, dynamic and self-sufficient. So there were some changes taken place in the economic reforms, like reducing the conditions of industrial licensing. So earlier what happened is there were much restrictions and conditions which were there for getting the industrial license. So those conditions were reduced after the economic reform or new economic policy 1985, and unnecessary controls and the restrictions for the progress. So in order to get or promote the industry or to get development, so there were some restrictions and control. So such unnecessary controls were eliminated or deleted. The next is it gives scope for the technological upgradation. Then the fiscal system. So we know fiscal system, fiscal policy we have already studied. So it is nothing but it is a, or we can say here the government is going to collect the revenue in this form, right? So the next is regulation of import and export policy. So some regulations were there on import and export policy. The policy initiated several measures. Some of them are like decontrol of cement, sugar, drugs. So more number of permits and license given to the business in the private sector. So electronics industry was given more scope, and the new import and export policy was announced, so giving encouragement to the export. So this was regarding your new economic policy 1985. The next is new economic policy 1991. So this policy was taken under the leadership of Prime Minister P.V. Narasimha Rao and Finance Minister Manmohan Singh. So why it was, or what may be the objective of this? So when there was a consequence of a BOP crisis, when there was some problem in the balance of payment which was faced by India, so in order to come out of that, so this policy was passed. The next is important policy reforms. Which was the important policy reforms? So like your LPG means liberalization, privatization and globalization. So what is liberalization? So liberalization is nothing but more whatever restrictions were there so far, so procedures and restrictions for your licensing policy and the conditions of your MRTP, all such things were reduced or freed. Then the next is your privatization. What is this privatization? Privatization, as the name itself indicates, more encouragement was given to the industries in the private sector. The next is globalization. Globalization is nothing but the Indian economy was made to interact more freely and openly with the global economy. Foreign direct investment was allowed. So all this liberalization, privatization and globalization is one of the reforms under this policy. The next is your new public sector policy. So new public sector policy says that, so those all public sectors units which were depending upon the government for its finance was reduced, and they were made to raise the finance of their own. Okay, so they were made to raise their finance of their own. The next is modernization. Modernization is nothing but, so some incentives were given to the industry to modernize. So the firms were encouraged to spend more on the research and development. So tax concession was given, other facilities were offered to develop new technology. So IT/BT industries were more supported. So the next is your economic reforms. So economic reforms, financial reforms. So financial reforms So these reforms or undertaken in the areas of the finance, like CRR is there, SLR is there, so reduction in that, reducing the interest rate, so financial institutions and the banks, so more freedom was given, and non performing assets, capital adequacy ratio to the bank, so the provisions for that, so all these things were allowed. The next is fiscal reforms. So the fiscal reforms is nothing but it was aimed to bringing down the fiscal deficit. What is fiscal deficit? It is nothing but the difference between the total income of government and its total expenditure. So the fiscal deficit, to reduce that, to bring down the fiscal deficit from 8% to 4%, it was there. So measures were undertaken to bring the financial discipline in the government spending also. So when the discipline in the government spending is been undertaken, so expenditure will automatically reduce and there will be the fiscal surplus. So the next is trade policy. So trade policy is specifically or particularly for the foreign trade policy which is made or which will allow the business to compete with the foreign country, and it is made the business friendly to by reducing the restrictions on imports and exports, are reducing the custom duty also. Custom duty means whenever you are going to bring the goods from the outside, so you are going to pay the duty called as custom duty. So it was a custom in the earlier days, so that the king or any person who is going to come from the other country, they have to give something as a gift to the people who are there in the nation, so that was a custom, so it is called as custom duty. The next is industrial policy. So this we have already studied also. This the terms and conditions for the promotion and organization of industrial activities were made the business friendly through the industrial policy 1991. So thank you.